everybody. Thank you for taking time out of your day to join us here at Western Marketing. We're going to go through voluntary life and health plans. We're going to kind of focus predominantly on the new group term to 100 life plan with long-term care benefits. And John's definitely going to kind of get into details on that one for you guys. But we are going to kind of touch base on all the other, do a quick review of all the other voluntary group products that the standard has to offer. Many of you might already be set up. This is technically they were Allstate benefits at one point, just the voluntary side. They were purchased by the standard. So that's going to be still the same contract and everything, but it is going to be slowly, I believe they're updating all the materials to kind of switch over to the standard. The plan for today, what we're going to be doing is we're going to have John kind of go through all the product lines and everything. And then once that's done, I'm going to unmute everybody, and then you can kind of ask questions and we can kind of just go back and forth discussion based. Just kind of housekeeping on that one. If somebody is talking, please don't interrupt them. Just kind of let them go. And then once they're done and the question is answered, feel free to pipe in with any of your questions. You can also just use the question box over on that right-hand side. Feel free to ask the questions on there, and I can pop those out as we get them towards the end there. But yeah, with that, I'm going to go ahead and toss this over to John and let him present, and I'll be quiet.
Thanks, Taylor. And no need to be quiet. Please chime in if there's something that I'm not covering deeply enough, or if I need to move on. But thanks for having me. Thanks everyone for joining the call today. I know it's a busy time of year, so I appreciate you taking some time out of your busy schedules to join the call today. We're going to get started. Taylor, let me know if my screen is not changing, but I think we're good. So as Taylor said, I'm John Johnson. I'm the Senior Employee Benefits Consultant supporting Western Marketing. I'm with the Standard, the American Heritage Life Insurance Company, which is part of the Standard now. As Taylor touched on, formerly we were Allstate Benefits. If any of you have business with us right now on the voluntary side or contracts, please know that you don't need to do anything. All the contracts, all of the agent contracts and master insurance contracts are all with American Heritage Life Insurance Company, so nothing needs to change on your part. My background, I've been in the insurance business for 30 years, the last 25 years specializing in employer voluntary benefits. The last 22, I've been with Allstate, now the Standard. So that's just a little bit about me and where I come from. We're going to talk today about voluntary supplemental life and health products. I always like to start with the why. Why do we need these products? Why do our groups need these products? So that's what I really like to focus on. As Tyler mentioned, we have a new term life product with long-term care. It's a new hybrid product for us. We're really excited about it. It's getting a lot of activity, so I'm going to focus on that to start. And here's my why. When I look at the life insurance industry and look at industry surveys, and I see that only 52% of consumers say they own life insurance. And keep in mind, that's a combination of people who own their own policy or people who have life coverage through their employer, which really is not their policy to take with them. And I always look at, what about the other 48%? Keep in mind that the first life insurance contract was written in the year 1583. So we've had 442 years of this industry, and we've only got 52% market penetration. That to me means there's a lot of people who need coverage. That translates in, there's an awful lot of opportunity for us out there. And when I look at the fact that according to a 2024 LIMRA study, there's over 102 million uninsured or underinsured adults in the United States. That's a huge market potential for us all. When I look also at the fact that the hybrid life product, we have the option at the group level of including long-term care coverage, that really makes us a unique product. It's what sets us apart from all of our competitors. And you look at 90% of Americans have not planned for long-term care, yet 70% of us will need long-term care. 70%, that's more of us than will use our automobile insurance or our homeowners insurance. And yet we all have that. We are significantly underprepared for our needs during periods of long-term care. And you can see that comes at later ages. 92% of care begins at age 70 or older. And men, we don't do as well as women. Once we enter long-term care, we don't survive as long. So that's something that I want to point out, some options later on as we talk through this. So keep those figures in mind. So what's our solution? Voluntary supplemental life. Specifically, voluntary supplemental life through American Heritage Life Insurance Company, the standard. The premiums on these plans are all paid by employees through payroll deduction. So there's no cost to your employer clients. And really important here, the coverage is portable. It does not need to be converted. They simply move the premiums from payroll deduction over to monthly bank draft ACH. The coverage stays the same. The premiums stay the same. They own this coverage. They can take it with you. That's a really important thing to understand. That's a big difference between employer paid group term life and the voluntary supplemental life. It provides a way for you to help employees fill their financial gaps. And we are able to provide coverage to the employees, their spouses, and their dependents, all of it being payroll deducted. When I talk about hybrid life, that is when we have a life plan that we combine our long-term care benefits on those policies. So now we're covering two different events in life. We're covering filling solutions, filling the gap for two different problems that employees are having. So with our term to 100 life, we can do that with or without long-term care benefits. We also have, that I'm only going to touch on just briefly, group whole life that is with or without long-term care benefits. An important item to note, the decision to include or not include long-term care benefits is made at the group level, not at the employee level. Moving on, just want to talk a little bit about the plan design. This is term to 100, coverage with long-term care. Just again, to reiterate some of the statistics, 7 out of 10 people are going to need long-term care. We know all of us at some point are going to pass away. So that's a given, but the fact that there's 70% chance that we are going to need some form of long-term care is a big deal. Now, the configuration of this plan is the premium is guaranteed level to age 100. At age 100, the policy terminates. The coverage is gone. So whether that employee is 25 years old or 65 years old, once they enroll in that coverage, the premium does not change. It stays level through their age 100. So they don't have to worry about it. I'm this week meeting with some people because I've got a 20-year term life policy that matures this year, and I have to figure out what I'm going to do with that coverage. I'm certainly not going to keep as much coverage as there is right now because the renewal rate is about 5x what it was when I took it out. So I've got to figure out a way to continue with some type of life coverage. If I had the term to 100, I wouldn't be having those conversations. So how does the term with long-term care coverage work? This is a qualified long-term care rider that is placed on the policy. You can see it's the fourth item down. It says 7702B. That's an IRS code, and that distinguishes a qualified long-term care plan from a non-qualified long-term care plan. So this is qualified long-term care. The base long-term care coverage pays out a monthly benefit of either 4 or 6% of the death benefit. So if there's no difference in premium, so I always configure these with a 6% monthly benefit. At a $75,000 policy, that translates into a $4,500 per month long-term care benefit payment. That will pay out the full amount of the death benefit. So for a $75,000 policy, it will take a total of 17 months and the death benefit will have been paid out in full. And you can see it says plus extension. So at that point, after 17 months, if that person is still receiving long-term care, we will continue paying out the long-term care benefits for an additional 17 months, paying out 200% of the death benefit. So that $75,000 life policy that you enrolled that employee in will pay out a total of $150,000 of long-term care benefits. And you can see it also says plus restoration. That means that at any point during the policyholder's life, assuming the policy's in place, when they pass away, the death benefit is always restored. So even if we have paid out $150,000 of long-term care benefit and they're still living, they keep that policy in force. When they pass away, we pay the beneficiaries the $75,000 death benefit. So the plan will pay out up to 300% of the death benefit. That $75,000 policy you enrolled them in suddenly becomes a $225,000 benefit. That's a huge deal. And again, we can pay that out at 4% per month or 6%. We still will pay out up to 200% either way. Again, since there's no premium load for the 6%, I always choose that when I run, when I set up the groups, because this is not a fee for services benefit, it's a lump sum benefit. As long as they're receiving treatment, and we'll talk a little bit more about the qualifiers, we pay out that full $4,500 on the long-term care if it's a $75,000 policy. So an example is if they're receiving care at home and they have a qualified service provider come in twice per month, a minimum of twice per month. With my parents, we used Visiting Angels. And my recollection is those were each about $300 visits for those charges. So after we take that $600 and pay them, there's still $3,900 that policyholder can choose to do with whatever they wish. They could use that to pay a family member, or they can put it in a bank account and stock it up for the time when they might need to go into a nursing home. Premiums are age specific, so it's based upon that employee's age, and the rates are tobacco distinct. So we have tobacco, non-tobacco. They're not gender specific, so there's no rate difference for male or female. Coverage does go to age 100. The premiums, again, are based upon that policyholder's age at policy issue, and they are guaranteed not to increase at any time through their age 100. Now, I don't want surprises. I hate surprises. This product, while it guarantees the premium, the death benefit is guaranteed for the first 5 years. And I know that sounds a bit scary. So I want to talk about that a little bit. We do expect the death benefit or the cost of insurance to remain level. We don't anticipate that we will ever have to increase the cost of insurance on this policy, which would lower the death benefit when they're paying the same premium. We've had this product in place since 2013. So it's been in place for 12 years. We went through COVID. The spike in death benefits during COVID did not have any impact on our decision on whether or not to change the cost of insurance. In fact, we would need something, an event that was worse than COVID and lasted 3 times as long. COVID was really a 1-year blip as far as the death claims exceeding our expectations. That period of time was a little less than 12 months, and then it went back to normal. And so for us to have a need to change the insurance, it would have to be an event that was worse than COVID and lasted 3 times longer. So when I look at that and I see the history of the policy and I see the history of our other life policies out there, we've not ever raised the cost of insurance on any of our life products. In fact, we've lowered the cost of the cost of insurance on our products over the years. Now, one other thing to note, when we add the long-term care rider onto this policy, the long-term care benefit is based upon the original policy issue amount. So let's say we have a mega bird flu that lasts for 5 years and it kills millions of people, and we have to change the cost of insurance. That could result in that $75,000 policy now being only $60,000. The long-term care benefit is always contractually based upon the original death benefit of $75,000. Another item to note, when we built this system out in our administrative platform, we didn't build in administratively the ability to change the cost of insurance. So before we could even do that, we would have to go in and do an overhaul of our admin system to be able to accommodate that. So that tells me we don't ever plan to change the cost of insurance. Historically, if we've had to change the cost of any of our plans, we've grandfathered in the coverage that's in place, and we come out with a new product. For example, we now have group critical illness 5 available. Well, we had 4, we had 3, we had 2, and the prices have gone down over the years. And when we need to make a change, it's been accomplished through rolling out a new product. So I wanted to cover that. I didn't want any surprises on the back end. Okay, so how does this work? Taylor, how am I doing? Any questions from your end?
No, it looks pretty good to me. We had one question, but I was able to answer it, so no problem.
Okay, so here's a scenario of how this policy works. I've got 3 different scenarios here. To keep my math simple, I'm using a $50,000 face amount policy and with a 6% monthly long-term care benefit. So in scenario 1, that policyholder never needs long-term care. They have the coverage, they pass away, we pay the beneficiaries the $50,000 benefit. Scenario number 2, the person becomes chronically ill. Our definition of that is the inability to perform 2 activities of daily living or chronic impairment like Alzheimer's or dementia. So they're chronically ill. And in scenario number 2, the person requires 6 months of home health care, followed up by 20 months in a facility before they pass away. So with a total of 26 months of long-term care benefits being paid out, that's $78,000 plus the $50,000 death benefit. The total benefits paid out in that scenario would be $128,000. Scenario number 3 is the maximum benefit is paid out. Jane is certified as chronically ill. She has a combination of 34 months of 6 months of home health care and 38 months of nursing care. The total number of months that we would pay out the long-term care benefit is 34. So in this situation, we would have paid out $100,000 of long-term care benefit and $50,000 of death benefit, all from that one policy. So again, I look at this and say, not only is it unique, it's very powerful. When you can make your premium dollars do 2 things, That's always powerful to me. The underwriting. So everything that we do, everything that we will talk about, whether you're speaking with me or Taylor or Sandy, all of our coverage in new groups is guaranteed issue. So in groups of sizes of 3 to 249 employees, our guaranteed issue amount of coverage on this product is $75,000 for the employees, and that's employees up to age 70. The math is wrong here. It should be $150,000 the long-term care max benefit, so it's double. So apologies, I missed that in my edits. Working spouses, so as long as the spouse is actively at work 20 hours a week, their guaranteed issue amount is $30,000. Their long-term care benefit max amount would be $60,000. Non-working spouse is $10,000. And then we typically cover children on a children's term rider at $20,000. Please note that the children's term rider does not include any long-term care coverage. They can stay on that rider through age 26, and then when they age off, they can convert coverage from the children's term rider into an individually owned policy for up to $100,000 of coverage on a guaranteed issue basis. We require 6 employee enrollments to issue coverage. If we are only offering this life product, we need 6 employees. If you are also offering one of our health products that we'll talk about shortly, then we need 3 employees enrolled in each of those lines of coverage. So it could be the life plan and an accident plan, or the life plan and a hospital indemnity, or the critical illness. If you put 3 lines of coverage in, say the life plan, critical illness, and hospital indemnity, then we need 3 enrollments in each of those 3 plans, so there would be 9. But again, we can go down to a group of 3. It's guaranteed issue. That includes guaranteed issue coverage on the long-term care. This is a bit out of date, so I'm going to have to talk through a couple of recent approvals. These are the states where our term life with long-term care has been approved. The green states are the states where we have approved it, but now effective with January 1, 2026 policy issue, we've also approved Connecticut, District of Columbia, Florida. Keep in mind, Florida, the only option they allow in the long-term care is the base long-term care. So a $75,000 policy in Florida will only pay out $75,000 of long-term care. So it's one unique thing. I have no idea why they approved it that way, but that's what we're constrained with in Florida. Also, Guam, state of Iowa, Idaho, Mississippi, Ohio, and Puerto Rico. Those are all newly approved states. So we're getting there. All the other states have been filed, we're just waiting for approval. Okay, apologies, had to grab a drink of water. So this is why we're focusing on the term to 100. You can see we do have a whole life product. The difference between the two, the whole life product, the premiums are guaranteed level, and the coverage is guaranteed level. That policy goes to age 121. So it extends out further and it generates cash value. But you can see for a 45-year-old, it's $400 a year more. And if we are solving for life coverage and long-term care coverage, the value, the cash value, kind of loses its luster, because if we are putting a product in place that we want to be there until it's used, the option of terminating that policy and taking the cash value out kind of becomes less important if we want it to be there when the person really is going to need it. So you can see the premium decrease between the whole life and the term to 100 at various stages. So premiums are significantly lower. But if you have a group that is interested in a plan where there's cash value and both the premium and the death benefit are guaranteed, we can also talk about that policy. Okay, Taylor, any other questions come up?
Just had a question about if you guys are ever gonna think about New York. I'm assuming that would be a no, as in most of the time that's a no, but figure I'd throw it at you anyway.
Yeah, right now, I'm not aware of any plans. The issue with the state of New York is to provide coverage there. The insuring company has to be domiciled in the state of New York. American Heritage Life does not have a domiciled company there. Now, to be honest with you, I don't know if the standard insurance company does. That would be the only way we would ever be able to offer coverage in New York, is if we take that product and file it under a company that the standard might have in place. Now, keep in mind, I just had an agent start enrolling a group, and they're based in Wisconsin, but they had about 6 employees in the state of New York. Since the group contract is based in the state of Wisconsin, we are able to write those New York employees. We have to be careful. There are times that there are groups that are actually located in New York, and if they have 100 employees and 75 of them are located in New York, and there are 10 of them in the state of Iowa, we would both get in trouble if we tried to domicile that group in Iowa with 5 employees when the majority of them are in New York. So we do watch out for that. But when there's just a few employees in that state, we can write them under the group contract out of the company's domiciled state.
Perfect. If they have members of their group that are over 65, are we able to get them coverage?
Yes, guaranteed issue up to age 70. So absolutely, working, if they're actively at work 20 hours a week or more, the guaranteed issue goes up to age 70.
Okay. If they already have a group life plan with another company, are they able to add this as well?
Yes. Keep in mind, this is a supplemental plan that's paid for by employees through payroll deduction. So key word there is supplemental. So if they've got that employer, that $25,000 employer paid group term life plan, when they leave, they have to convert that over to a permanent policy with that carrier. It's not always easy, and it's rarely inexpensive. With our coverage, again, it's designed to go over the top and supplement that. We've also had multiple groups where most of the employees already had long-term care. We've written a couple of wealth management, financial planning groups where 70% of the people had individually owned long-term care products, but over time they've realized that the amount of coverage they had on those, it was not adequate for their desires. So they were able to enroll in ours and get that extra level of coverage. So absolutely.
And then we also have, so since this is a employee paid, is there a way for the employer to pay it?
We do not allow that on the group term to 100 product. We do allow it on the group whole life, which we do quite a few of those, especially with small, closely held companies that they want to do that for all the employees. So if we have a group that the employer wants to pay coverage, we would use the group whole life, and we do allow it there.
Perfect. That's all I got so far.
Okay. Taylor mentioned at the beginning that we also have supplemental health plans. So I want to talk about those briefly and show you how they can become part of the solution along with that life plan. And again, I always start with the why. When you look at your group medical plans that you have out there, if you have group health plans, the out-of-pocket expenses today, most families cannot afford. Average income in the U.S. is a little under $60,000, but the big number here is that almost 71% of people have less than $1,000 in savings. And 65% of bankruptcies in the U.S. are caused directly by medical expenses. So the problem we have is that nearly 71% of people with health insurance cannot afford to get sick or have an accident and use that coverage because they don't have enough money available to pay deductibles and co-insurance. So I always kind of ask the hard question, are we as an industry, are we providing a solution with health insurance, or are we providing a false sense of security? You know, how many people have you talked to and they said, well, I'm okay, I've got health insurance. Well, they've got health insurance, but they may not be okay. So if we look at an example of a group, so let's say you have a group and the medical plan you installed has a $3,000 deductible for the individual and then 80/20 co-insurance. So that means the deductible for the family might be $6,000. When we look at the co-insurance, the total out-of-pocket exposure is going to be $6,000 or higher. So let's go back to one page here, and we look at 70.9% of people have less than $1,000 in savings. Now that person has a heart attack, or they have an automobile accident, or it's fall, it's hunting season. What if they have an accident out hunting? Most people can't afford that. So how do we solve that problem? And how do we provide clients with more financial security? My solution is supplemental medical plans, supplemental health plans. The benefits from these plans are paid directly to the employee. Premiums are paid by the employee, so there's no cost to the employer. They are a great way for allowing employees to customize their benefits to fill those gaps. Typical options are group accident, critical illness that includes cancer, hospital indemnity. Now, I'll use myself as an example. My kids are daughters. I've got 3 daughters. They're grown and out in the world on their own now, but when they were young, they were all involved in sports. And I always selected the high deductible health plan just because we were, as a rule, we were healthy. And it was so much less expensive than a low dollar PPO plan. I always allocated some of the savings of going to that high deductible plan. And for years, I had an accident policy on our family. I can't tell you how many trips to urgent care in the ER we made because of sports. We had dislocated knees, had a broken thumb. We had a broken arm. We had a couple of teeth knocked out in a swimming pool event. We were a big user of that accident plan. Sometimes it covered the majority of our cost. Sometimes it just covered a good portion of it, but it always helped soften the blow of that unexpected medical event. Because my wife was always concerned, she handled the books for the family, the checkbook and paying the bills, and she was always concerned about what do we do if we have to suddenly come up with, back then it was $2,000. Well, here I've got an accident plan, and with the dislocated knee, the benefit we got was over $2,000 between the dislocation benefit and the ambulance and the physician's attendance. But the accident plan pays benefits for hospitalization, daily hospitalization, ambulance benefits. There's a fracture and dislocation benefit. I no longer have an accident policy. So full disclosure, when the kids were grown and no longer active in sports and on their own, I canceled that policy. I still have the critical illness policy because what I worry about for my wife and I is heart disease and cancer. Heart disease for me because it runs in my family. Cancer for her because that runs in the family. And I don't want to, particularly with cancer, I don't want to have to worry about how on earth we're going to pay that huge deductible and co-insurance. And I also want to have funds available so that if we decide we need to go out of network to get the best treatment, we've got the funds to do it. So that's one policy I will always keep. The hospital indemnity policy is a great product for those groups where you have a lot of middle-aged younger people that are in that age bracket where they're having kids. It's a great plan to put in place to help them plan for the expenses of having a child. So it's a wonderful product as well. So those are some of our supplemental health plan solutions. And let me see here. Okay, how do you move forward? We don't quote individual groups. Well, Taylor, did you just lose my screen?
Yes, it looks like we lost your screen. Nope, it's back.
Okay, so sorry. I'm having some strange issues on my end. I'll get down. What screen do you see right now? Is it the first one?
The very first one.
Okay. So I'm not sure what's happening on my end, but I'm going to go. I apologize. You'll see the screens on the left. Okay, so I was saying, do you see the screen, how to offer supplemental health plans, Taylor?
You sure do.
Okay, you don't need to quote. You don't need an individual quote. All the plans rates are standard plan designs, standard rates. There are some variations on a state-by-state basis. We've just enhanced and updated our small group plans. So as you have groups that you want to look at introducing these to, we will generate the brochure for you for your specific state and for the plan. Again, we can go in groups as small as 3 employees with 2 lines of coverage. We underwrite the group, not the employees. So I sent Taylor earlier a list of restricted industries that if you have a group and you're not sure, will we take that group? Give Taylor a call, give Sandy a call. They'll double check it. We write the vast majority of all groups out there. We don't like lumber companies, so we don't like loggers. We don't like offshore oil rigs. But there's not many groups that we turn down. You can enroll these using paper enrollment forms, or if you've got groups that are on an employee benefit enrollment system, our plans, we've had them on over 200 different benefit platforms. If you want a benefit platform, we can provide the Easy Apps online enrollment system to you at no cost to you, no cost to your client, as long as we have 2 American Heritage Life voluntary plans on that group. And you can put other plans on there. If you have VSP Vision, you can put it on Easy Apps online. If you have a small group medical plan, you can put that on there. And the Easy App team will build all of those out for us, so you don't need to be an expert on their platform. Technology always jumps up, doesn't it? Okay, next steps. What do you guys do from this point on? Well, what my recommendation would be, look at which of your groups that you have medical plans in place and look for the groups that you think, okay, are the out-of-pocket costs realistically too high for their employees to handle on an unexpected basis? If the answer is yes, great opportunity for supplemental health. Look at your groups and try to identify groups where there's no employer paid life insurance being offered. There's more and more of those. When we transitioned from the Allstate Corporation to the standard, it was kind of a breath of fresh air at the Allstate Corporation. So as an employee of Allstate, 50,000 plus employees, insurance company, they did not provide us with any employer paid life insurance. Shocking. No employer paid life. We had the ability to buy voluntary life, but that was it. So look at your groups. There's a lot of them out there that don't have employer paid life. If you have them, great opportunity for the supplemental life plan. And I want to let you know, we can do that group term to 100 with or without long-term care, but that's a decision that is made at the group level, not at the employee level. But just know if there's not a desire for that, they don't want to look at it, we can do it without that. And Taylor, to circle back to one of the questions earlier, we do have the ability, and it's very okay to have the supplemental life plan in place when there's employer paid coverage in place. Happens all the time. And for those of you that have groups with supplemental employer paid life coverage, think about when was the last time they reached out to you or an employee reached out to you and said, hey, I'm leaving Joe's manufacturing company and we've got that $25,000 life policy. I want to convert it. How do I do that? It happens so rare that most people don't even know the process to go about doing that. So when employees leave their job, most of the time they leave their life insurance coverage behind, with the exception of ours. They just complete a bank draft authorization form, and it moves over to monthly bank draft out of their checking or savings. What do we need to get you information for the groups? We just need the name of the group, the address, so really city, state will work, the number of employees, the plans you want to offer, the coverage date that you are targeting, when you'd want to start the enrollment. If you're using a benefit enrollment system that's already in place, or you want to use Easy App Online, we would train you on that system as well. We want to make sure you're appointed with American Heritage Life. If you're not sure, call Taylor, call Sandy. If you're not, we'll get you appointed quickly. If you want printed brochures, let us know how many and where to ship them. If you would like help presenting these plans out to your group, again, you could call Taylor, Sandy, and they could call me. I'm always happy to help. And then we have a group setup document that I would get to you, have you and the employer sign. That's what we use to set up the group internally. Once the group is enrolled and you're looking at what are the next steps, number one is we got to get a participation report and the payroll deduction. So if it's paper, there's a manual spreadsheet we can provide. If it's on Easy Apps Online or another platform, we can pull that from the system. One thing to keep in mind, our plans are billed in arrears, but you need to have the payroll deduction information to the employer before the start of the month when the coverage starts, so they can start making payroll deductions. So for example, January 1st group, coverage goes in place January 1st, and let's say that group pays their employees semi-monthly on the 15th and the last business day of the month. They would want to have those deductions amounts in their system so that on January 15th, they make 1/2 of the monthly deduction amount, the semi-monthly premium amount. On the last day of the month, they would make the second one. They would receive a bill from us around the 27th or 28th of January for January coverage. It would be due into us around the 8th of February. So we bill in arrears. We don't ever want an employer to front the money for their employees. Because if that employee leaves mid-month and they only make one deduction for the one semi-monthly deduction, that's all the money we want them to send us. So even if the bill says they owe us, the premium is 40, they only collected 20, we only want them to send us that 20. And then we can move them to bank draft. I always like to have a billing call with new groups. So on about the end of the month of January, it's always good to have a call with them. I would participate in that with you. Make sure we have everybody they're expecting on the bill. We've got the names spelled correctly and the premiums on the bill match the premiums that we provided for their payroll deduction. Once, always easier if there's a mistake, if we catch it early, it doesn't become an issue. If it festers for 6 months, then it becomes an issue and it's harder to unravel. Closing from my end anyway, I always want to have a what's next from these calls. So I guess from my end, what I would advise you do, look at your book of business, look at groups and identify them where there's no supplemental life or health, or where you think it would work. If you are sure whether or not it's a qualified group for us, call Taylor or Sandy or me, and we can check the SIC code. We can also send you a list of restricted industries. And if your group is on the restricted industry list that we have, please don't walk away. Treat it as a yellow caution light. Get in touch with me so I can bump it up and look at it. We still end up writing most of the groups that are on the restricted industry list. Make sure you're appointed with us. My recommendation is when you are introducing supplemental employee paid plans initially, it's best to only offer two. Because if you give people too many choices and they can't decide, oftentimes their choice is to do nothing at all. Make sure we've got the state-specific brochures for you. Schedule implementation and enrollments with the groups. We can provide communication materials, product videos, emails. And I look at this, solve a problem for your the employees of your groups. Adding lines of coverage increases the persistency of your groups. They stay around longer. And when you add lines of coverage, that increases your income. So it's a pretty good situation when you can solve a problem, and when you do that, you make more money. Taylor, that's all from me. I'll turn it back over to you and see if there's any questions.
Yeah, we got a line of a few questions here. I'm going to kind of work my way up through them. Okay, so one of the scenarios that was asked was, let's say the husband is currently the one that is employed and working and is under the age of 70, but the spouse is over the age of 70. How would that work? Would the spouse be able to get coverage?
We would, depending upon the age of the spouse, we can issue up to ages 80 years old, but it requires evidence of insurability. So we would be able to issue. It's based upon the employee's coverage is based upon their age. The spouse coverage is based upon their age. So employee would get guaranteed issue coverage. The spouse would have to provide evidence of insurability.
Okay. We got kind of a long one here from John, but what if a client is covered and about 2 weeks prior to his or her 100th birthday, they go in a nursing home and stay there for several months? Is the plan going to stop paying the nursing home benefit once they reach the age 100, or will it continue to pay beyond their 100th birthday in this scenario?
The plan and all benefits terminate at age 100. On the term to 100, all benefits would terminate at age 100.
Even if they're currently on claim?
Yep, yes.
Okay.
The group whole life, that coverage extends through age 121. So they would be okay if they had the group whole life.
Perfect. And then the premiums shown for the term are calculated by what payroll frequency?
The payroll frequency of your specific group. So if your group pays their employees on a weekly basis, we would have brochures for you with rates that are weekly, or whether the group is biweekly or semi-monthly or monthly. We do a lot of school districts, and we do tenthly. So we take the annualized premium, divide it by 10, and they tell us the 10 months where the teachers, or the 9 months where the teachers are being paid. And if they have staff there that are year-round and they're paid semi-monthly, then we would have multiple payroll and we would show premiums in multiple different payroll modes. That's an easy solve.
Okay, perfect. On the presentation, I think you showed annual rates, didn't you? For those, yes. For the term? Okay, yeah. That's what I thought. All right. Well, everyone, I'm going to go ahead. I'm going to unmute everybody. So if you see on your computer there's a mic button. It'll be red with a little slash through it. That means you're currently muted, but you can unmute yourself and talk. Again, if somebody else is talking, please don't interrupt them. Just let them finish, and then you can ask your question right after. So I'm gonna go ahead to unmute because I do see a couple hands up. All right, everyone is unmuted. So if you have a question and you want to ask it, feel free.
Everybody got quiet.
Does this work for 1099 employees?
Unfortunately, no. It's only W-2 employees are eligible. We are not able to do 1099 employees.
Really? Okay. Because I have an employer. It's like a funeral home, but everybody there, even the full-time employees, actually, you know, they work every day, but they're 1099. So
yeah,
it's not like, okay, so but no 1099 at all.
Correct. Yeah, unfortunately, we'd love to be able to do it. That would open up a lot of things for us, but we've never been able to get approval for that.
Okay.
Good question, though. Thank you.
Yes, sir. And you're John?
Yes. Mm-hmm.
So I guess let's see. I would assume that a lot of guys simply do everything. I mean, nobody goes out anymore to present these things to a group. They have relationships and everything is done remotely, I would assume, right?
Today, I see really a wide range. There are still some agents that go out every year in person, and when they're going out doing renewal meetings on the medical plan, they present these plans in person. There's a lot of groups where our agent doing the supplemental plans maybe doesn't have the group business, but they have the ancillary and supplemental. Some of those still go out and do group meetings. There are some that do, they might do 2 or 3 voluntary group meetings where employees who are interested come in, but there's the majority of them today are done remotely through a series of Zoom calls. We can do email communication. So we can provide email templates to you as the agent to provide to the employer. If they all have company email, they can be sent out. Those are actually very effective because we can embed the product video in it, and that really they get a high click rate volume, and it's almost better than the in-person meeting because they can do it remotely and at their leisure. The enrollment platform that we can provide, it's not our own, we don't own it, it's a partner, the Easy App system. They also can embed in their videos and the brochures, and people can go and look at it. It's mobile enabled, so people can do it really anywhere at any time. But it's a combination. The more communication and the more effective the communication, the better, because we all know, we're all in the insurance business, but we all know people don't want to buy more insurance. And unless they realize that they've got a significant risk in here so they can solve it, they aren't going to just randomly enroll in coverage. So key is communication, whether that's in person or remotely. Today, very much a combination of all of that.
And we've seen, I work on the group side here, and so I do talk with quite a few agents. A lot of them are still physically going out to those locations, even to get new groups these days. Sometimes that's the best way and the most direct way to actually get in front of some of these groups, just even kind of get in the door and get that conversation started, is to actually physically go to a location and see if they can talk to, whoever's in charge to even get in front to be to be able to offer these types of things.
Yeah, that works. I did it for years. I did employee benefits for years, so I know. I've hustled. I've gone all over the country doing so. I'll never do it again because look, I paid my dues on that.
Yeah.
So mine would all be just relationships that I have already to do it now. But yeah, look, my days of driving 50,000 miles a year are over. Okay, so
Yeah, I don't blame you.
That's why I mentioned that. But
yeah, the enrollment platforms that are available today, Employee Navigator, Business Solver, Plan Source, Easy App Online, they all allow for, most of them all allow for either an agent-assisted on-site enrollment environment or self-service, where from home or their desk, employees can go into the system and enroll at their leisure. So a lot of them are done email communication, maybe a Teams call or Zoom call or two, and then, you know, here it's the 5th of the month. Please go in by the 10th of the month and finish this up. And you can go into those systems and see who has gone into them and who hasn't, and then do follow-up contacts, emails with the people that haven't to remind them. So yeah, that happens routinely now.
can I ask you this, John? I'm familiar with the other products that was offered by Allstate. They changed up the platform a little bit, but it's you're offering group benefits to individuals, if you will. Benefits like this, but you're offering them to individuals, like with the whole life, and the other benefits like the critical illness as well as the long-term care. Can you see that this could be offered as well individually, like the other products that are offered by Allstate, the whole life and the critical illness?
Right now, the voluntary plans that you know, we covered today that we handled, they're only done through the workplace, so through an employer-employee relationship. Back when we were owned by Allstate, you know, there were 3 different business units, and one of them was Allstate Individual Services. So they had individual medical, they had individual accident and cancer and CI, and they still do that. They're still owned by the Allstate Corporation. Ours are still just limited to employer groups. And we do some union groups. We do a lot of union groups as well, where there are multiple employer groups that are part of the employees are in as part of that union. So we can do unions, but it's still just through the workplace.
Yeah, I like this product because the one thing I like is, you know, like most of these products are like have a 5-year tiered where every 5 years the premium go up, but to have a product that's going to stay level is really outstanding. I haven't seen one like this before, where the premium stays level all the way through to age 100. That really makes a difference, because typically, you know, like when you go to work for a company and if you have a product that's portable, I'm working with a lady right now who retired from the county, and her products, I mean, it's laughable to see the cost even when you go portable, and then, I mean, when you look at converting, it's crazy, but to have a product that stays the same premium to 100 is fantastic.
Yeah, I agree. Prior to coming to Allstate, when I left my last corporate job, I inquired about the conversion process, and even HR chuckled and said, "John, you're not going to want to do it," is that the premium increase was 12x over what I was paying.
This lady who just retired, her premium for her policy, if she converted it, was going to be $1,800 a month. I mean, it was just like, it's crazy. And so I'm about to finish underwriting on policy. Now it's going to cost her like $3 something a month as opposed to $1,800 a month.
Yeah.
So this is really unique. I mean, and the way this works, where you actually restore and then get more. I mean, I've never seen anything like this. Go from $75,000, you could actually receive 3 times that amount. Is amazing.
Yeah, it's a unique product. It's what right now in the marketplace, our portfolio of the hybrid life and long-term care products are really, that's what's setting us apart, because they are unique. Taylor, I should have mentioned, I forgot this during the presentation, but to market this and sell it, you do have to have a long-term care certification on your license.
Yep.
So,
yep. So that's important to have for everyone, to make sure that they do have their long-term care certs. Long-term care certs, pretty easy to get. I do them all the time. Every couple of years or so, you get that refresher course in there. You can do that through WebCE. Counts towards your CE as well, so always a good one to do. If does anybody else have any more questions? Mark, I want to get appointed. Yeah, okay, Mark. Yeah, I'll reach out to you after this, Mark, and we can get you all set up. That's pretty easy to do. Just kind of wanted to touch base on, again, if someone has a group and they want to get started, one of the big things that we do here is we also do the group health insurance as well. Typically, my suggestion is to go in with the group health insurance and those voluntary benefits. You know, just kind of build up both sides to kind of cover both of your bases there. So you might as well get their main health insurance while you're in there. If you can't get their main health insurance, yeah, go ahead and get all their voluntary benefits too. So a lot of times, if you have a census, the census is just enough for what we need as well on the voluntary benefit side here with the standards. So no need to do double work on that one. But all you need to do is contact either myself or Sandy here. You can also talk with your life marketer if you work with Amanda or Tyler here, and they can also assist as far as helping out and getting these quotes out for you guys. So well, if there isn't any more questions, why don't we wrap it up here, and then feel free to give us a call here at Western. Phone number is going to be 800-852-7152. Once this webinar gets all finished up and cleaned up, I'll get it uploaded to our YouTube channel, then I'll get it sent out to everybody with a little bit of info on kind of what we covered today. So with that, I'd say let's go ahead and end it. And yeah, if anyone needs anything, just give us a call here at Western.
Thanks, everyone. Thanks, Taylor.